All right, here's the video that I was referring to, the article. It was just from Silver Doctors, and this is the one where they postulate about what these so-called meetings, private meetings, the Fed has just had 3, and then a private one with the President, Barack, but just about interest rates. No, as I said, this person, Dave Kranzler, I believe it is, believes these meetings are all about, guys, we have some weapons of financial weapons of mass destruction known as derivatives exploding in the background. If we don't deal with it, the whole world's economy is about to be destroyed. And one of our big banks, Deutsche Bank, is the mass holder of those instruments. And we don't want a daisy chain event to take place of failure after failure after failure, because this one insures that one insures that one. They all have derivatives. They all have credit default swaps, which are those insurance contracts. And if one goes down, they all go down. I think that's more believable than we're going to discuss interest rates in an emergency meeting. We need an emergency meeting all of a sudden. Unemployment, great. Jobless numbers, great. Economy, recovery, great. That's all we keep hearing. Great, 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 great. Stock market up, great. But we need an emergency meeting. 3 of them, as a matter of fact. And then another one with the president. This sounds more believable to me. Fed convenes emergency meetings. Has the next financial earthquake begun? The Fed announced a series of 3 expedited procedure closed meetings Monday through Wednesday this week. I would suggest that expedited rule closed door meetings held by the Fed were convened in order to discuss the Western financial system, which is obviously beginning to collapse again. Dave Kranzler, PM Fund Manager. The Fed announced a series of 3 expedited procedure closed meetings Monday through Wednesday this week. Federal Reserve Board meetings. The Monday meeting was allegedly a review and determination by the Board of Governors of the advance and discount rates charged by the Fed. This is somewhat an absurd waste of time, as both of those bank funding mechanisms have become antiquated and rarely used. The discount window collects dust until a specific bank's credit profile has collapsed to an extent that prevents it from accessing the interbank lending market. It's seen as an act of desperation. It's doubtful that the meeting was convened to discuss the discount rate. The announced subject matter of the 2 subsequent meetings are perhaps of more interest. Bank supervisory matter was Tuesday, and periodic briefing and discussion on financial markets, institutions, and infrastructure was for Wednesday. All of which would be in trouble and play a critical role if derivatives were to fail at some large bank. I find the latter 2 topics in the context of the fact that it appears that the European banking system, to which the U.S. too big to fail banks are inextricably tied, appears to be melting down. For me, the telltale sign for the Western financial system is Deutsche Bank. And Deutsche Bank has emerged as a rogue bank of sorts that has taken on a catastrophic amount of reckless credit market risks. Notwithstanding its literal financial nuclear portfolio of derivatives, Deutsche Bank thrusts its balance sheet into every sector of the global economic system that has been melting down over the past 12 to 24 months, including energy, commodities, Club Med, European banks, and junk bonds. It also began to choke to death on bank debt loans to companies like Glencore and Volkswagen. The trading action in Deutsche Bank's stock price has been unable to mask the underlying meltdown going on at the company. As you can see, Deutsche Bank's stock price has been significantly underperforming the BXK Bank Financial Index since mid-July of last year. Coincidentally, or perhaps not coincidentally, the S&P 500 suffered an 11% drop in mid-August. Bloomberg News released a report about 3 weeks ago that surprisingly received little to no commentary in the alternative media world. It was reported that Goldman Sachs and JP Morgan were in discussions to buy 1.1 gross notional amount of I think he meant trillion, 1.1 trillion gross notional amount of Deutsche Bank's distressed credit default swaps. I did do a video on this, by the way. That in and of itself was not necessarily interesting, but the article reported that Deutsche Bank had already sold off 2/3 of its distressed credit default swap book since October 2015 to Citigroup or Citicorp, which again, as I mentioned in the video about this, let's not forget Citigroup's the one that wrote the law in, I think, November-ish time frame of 2014, I think, that says bank derivative losses are now covered by FDIC insurance. And who passed it? Them good old boys and girls in Congress, and then the president. The credit default swap securities were single name, direct, or not cleared through DTC, over-the-counter derivatives, meaning they are of the riskiest, most unregulated, and most toxic variety. If you notice on the graph above, which I don't have, around the time that Deutsche Bank was engaged in selling some of its toxic waste to Citi in October, the stock began to take a dive, and it began to diverge negatively from the rest of the big bank stocks. I would suggest, and having been suggesting, that there's been a series of mini meltdowns that have been occurring in the Western financial system since late last summer. I've also written an analysis, which has connected these meltdowns to Deutsche Bank and has connected the stick saves in the markets to the Fed. I'm suggesting here that the Fed, Federal Reserve, is behind the Citi, Goldman Sachs, and JP Morgan credit default swap transactions with Deutsche Bank as a means of preventing Deutsche Bank's collapse. In other words, another too big to fail bank. We will do anything we have to do to keep it afloat, but this time we're not going to tell the public we need a $900 billion bailout or whatever, because these things are in the trillions, first of all. Secondly, we'll just have to deal with it behind the scenes ourselves. So who do we use? One of our tools. One of the bank's tools is the Federal Reserve. Who owns the Federal Reserve? It is a privately owned organization. The 12 member banks, Federal Reserve entities, there's 12 of them. The big banks. The big banks are the owners of the Federal Reserve. So they will use the Federal Reserve to bail themselves out. My question is, how do you do that when you have to report some numbers, as much as you like to hide them, and there's going to be trillions upon trillions of these rotten derivatives from Deutsche Bank somewhere in there? Where is that going to be shown? How are you going to hide that? Remains to be seen. After all, the too big to fail banks in the U.S. are catastrophically tied to Deutsche Bank and the entire European financial system via derivatives. Last week, Deutsche Bank stock began to sell off hard again. On Monday and Tuesday, its stock dropped 6.6% and was down as much as 9%, significantly underperforming its peers. It's my view that the Fed has been conducting an ongoing de facto bailout of Deutsche Bank since midsummer, using the balance sheets of Citigroup, Goldman Sachs, and JP Morgan as its proxies. So maybe that's how they're hiding it. In the context of the behavior of Deutsche Bank's stock recently, and in the context of what is now blatant market intervention in the stock market by the Fed, and in the context of the news of the bank bail-in in Austria, plus the collapsing Italian banks, which, by the way, Webbot report did say, look at the Italian banks. There should be some event happening in the near future with that. I would suggest that expedited rule, closed-door meetings held by the Fed, these were convened in order to discuss the Western financial system, which is obviously beginning to collapse again. I would also suggest that the Fed is inching closer to implementing more drastic monetary easing policy measures, which could include taking short rates negative and will likely include more money printing, either overt or cleverly disguised. This is why gold and the mining stocks have been somewhat melting up, despite the recent flood of anti-gold propaganda pouring from Wall Street in the mainstream media. It is likely that the melt-up in precious metals space has a lot more melting up to do. I'm finishing up my work on the mining stock that will be presented in the next issue of the Mining Stock Journal, which will be released Thursday. This is an undiscovered company that trades under 50 cents, and it's worth several times its current market cap just on its royalty properties. Oh, by the way, it's in the midst of drilling what appears to be a massive copper and gold porphyry in an area that has been previously ignored. Click here to access the Mining Stock Journal, he says. So again, this was Silver Doctors. Fed convenes emergency meetings. Has the next financial earthquake begun? I suppose I could put a link up for you so you can check this out. I just read the whole thing to you. But if you want to check out his journal, the link will be there. I have to say, what he has just said, not even one tiny little thing sits me as, well, I don't know if I agree with that. Maybe, but I'm not sure. Everything he just said sounds absolutely positively spot on to me. Every little word, every detail, everything. That's what they're doing with these meetings. We're having a meltdown. How should we handle it? It's another too big to fail, but this one is massively too massive to fail. Not too big. This one is a too massive to fail bank. And again, if a third of these damn derivatives that Deutsche Bank was holding are now gone, where did they go? Who has them? Where did they go? Well, again, we've seen Citigroup buying some, JP Morgan, Goldman, the club. But a third of them? I don't know about that. Again, where the hell do these things go? I got a feeling we're going to find out. And when we find out, it's not going to be pretty. But we will see. Take care.